Welcome to my channel. I'm the Covered Call Guy, and I'm trying to create a $120,000 passive income portfolio using only covered call ETFs. Right now, I yield about $72,000 a year, $6,000 a month, $1,400 a week, and about $200 per day. If you have the same goal, same mindset, trying to get into income investing, covered call ETF investing, or just trying to reach the same goal I am, please subscribe, leave a like, comment. I appreciate all of the love and support from you guys. I really appreciate it. Thank you for helping me grow as a better investor, and thank you for helping me grow on this YouTube channel. Guys, I really do appreciate everyone. I really mean it. Legal disclaimer before we start though, before I start my rant, this content is for informational and educational purpose only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete. Investing and trading involves significant risk, including the possible loss of principal, so please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube, and I could be completely wrong. Now, with that out the way, let's get on with my rant. I don't think this is I guess this could be an education informative, but this is more of a personal rant. I wanted to make a video on this because before the YouTube channel happened, and really when I was starting to rotate out of growth and into income, I was only really going to pick only 3 ETFs from NEOS, and that was SPYI, QQI, and BTCI. And I'm gonna be even more honest and transparent with you. I was going to almost all in just one of these 3. Almost did. BTCI. I almost put all $700,000 into BTCI, and that would have yielded me roughly anywhere from $30,000 to $40,000 a month. And I almost made that call, but I didn't. So let's just talk about what I almost did and why I did this and why I almost did it. So we're going to talk about the NEOS Income Trifecta: SPYI, QQQI, BTCI, and Chill. Right, it's going to be a quick tick on these 3 tickers and why I almost pulled the trigger and just had these 3 and just chilled and do nothing else. Right, the quick tick, right? It was your pursuit of financial independence has shifted from total return strategies to cash flow centric models, right? I was thinking this is, I had this in mind. I was really modeling it, stress testing it, and I was creating all these scenarios in my head, right? So this analysis is going to cover the NEOS trifecta, right? SPY, QQI, BTCI. The target was going to be, I was going to aim for at least 10 to 20%. So I was going to play around. I talk about the turbo, which is BTCI, right? It was going to be an aggressive annualized yield about approximately 18-20%. My goal was to scale from a supplement income of 1,800 a year to a full financial freedom of $180,000 a year. So I was thinking in my head, how can I do this? How can I achieve this, right? So I was gonna go in full financial freedom mode, and I was, I was looking at all of the funds, and I was trying to do a model stress test, and I was doing all these scenarios on, what could happen, a market dip of 20-30%, where it was gonna take me, and I almost pulled the trigger, and I still might. I don't know. Right, the simplicity premium, right? 3 tickers. I was only gonna do 3 tickers, right? I was gonna consolidate complex strategies into just 3 ticker symbols. Zero load, right? Reduce your cognitive load to near zero. No managing Greeks or strikes. I wanted to set and forget. Ideal for you if you prioritize cash flow over complexity, right? I didn't want all that complexity. I didn't want to look at my my app all the time refreshing. I'm like, oh my god, what's happening now? I didn't want any of that, right? SPYI, QQI was more just easy. The tortoise versus the rabbit. I wanted easy, slow, and just I didn't have to worry about it, right? I had, of course, Bitcoin was gonna be volatile, but I understood that, right? So I own Bitcoin. I own actual Bitcoins. I know about that. It wasn't gonna bother me, right? BTCI was the yield turbo, right? So that's why I picked it. BTCI's trailing distribution rate exceeds about 27%. I think on paper they were looking at what 35%, right? It act as a yield turbo to elevate the portfolio average to 18% target, right? It counterbalanced the lower yields of SPYI about 12% and QQI about 14%. The warning here though, this reliance on Bitcoin introduced contingent risk and volatility drag you must manage. So I asked myself that, I was like, oh, okay, if this happens to Bitcoin, which look, it went from 100 and what 30 to what barely pushing $90,000 now. So I understood that risk and I factored that in. All right, the macroeconomic case, right? Why old school income died and options took over, right? Let's just talk about traditional incomes, right? And why they failed. In my opinion, I say rest in peace to the 4% rule. For decades, you could safely withdraw 4% annually. This relied on bond yields and stock appreciation. The post-pandemic landscape fractured this. Real yields remained compressed. The failure, and that's what really shook my mindset, was in 2022. Stock and bonds fell together, destroying the balance bonds provided. That was not supposed to happen, right? So now we look into harvesting volatility, right? VRP, turning chaos into checks. You don't rely on dividends or coupons, you monetize volatility. For option sellers, volatility is an asset, a raw material to be harvested. My mindset started to change, my thesis started to change, right? The thesis was implied volatility, IV, was greater than realized volatility, RV. Fair is overpriced. Funds like SPYI and QQI capture this spread, right? Converting market anxiety into your monthly distribution. And I started to think, wow, I can make a lot more money while still being relatively safe. Avoiding the U trap, yes, when I did my due diligence, as for those who are new into the cover call or income ETF in general, you're going to have this topic come up, right? Avoiding the U trap. And one of the reasons why I chose NEOS was because they weren't known for U traps. So, or nav erosions. That is something you come up upon. And why did I choose these three from in the beginning? I was deciding. One, preserve your NAV, right? Don't lose your capital chasing yield. A 20% yield is useless if it comes from returning your own money. NAV erosion. The innovation, the NEOS distinguish itself from the Gen 1 funds like QYLD by using call spreads. And for those who are new, Gen 1, Gen 2, Gen 3, or made up terms by me. They're not actual, or at least I don't think they are. I just put Gen 1 because for the most part, these cover call ETFs kind of took place around the early, before the 2020s, and then 21, 22, 23 came the Jeppies, right? And then 23, 24, and now comes the NEOS and all these round hill and the yield maxes and the Goldmans, right? So that's what I say: Gen 1, Gen 2, Gen 3. Of course, for those who are new, for those who's been around, you know what I'm talking about, right? So this structural nuance is the linchpin for sustaining high payouts without cannibalizing capital, right? That was my biggest concern. I don't want to lose my capital, my principal. SPYI, that was going to be the rock of the trifecta. The objective was generate high monthly income in a tax efficient manner while maintaining potential for equity appreciation. The strategy: invest in S&P 500 stocks with a data-driven call option strategy, right? That was going to be the rock of my trifecta because for the most part, SPYI is a little bit less volatile compared to the tech and Bitcoin, of course. How does SPYI print cash, right? So of course we always gotta ask where that yield is coming from, right? That's one of probably the top 3 or top 4 questions when it comes to picking a solid cover call ETF. How does it print cash? One, It was the short leg. Fund sells call option on the SPY index. This generates the premium income for your monthly distribution. Step 2 was the long leg. The fund buy call options at a high strike. This allows you to participate in rallies, capturing the right tail of returns and growing the NAV. So when I was doing my research, when I was thinking about almost, pressing that button on just buying these three ETFs, I was doing my due diligence and I said, this is a pretty good strategy. And on top of that, SPYI had some historical data for me to look back on, and it survived and it rebounded, right? So that was very encouraging. Holdings, blessing or a curse, right? I asked all these questions of myself. The mega cap concentration. Nvidia was almost 8%, Apple was about 7%, Microsoft 6%. About 40% of the assets in the top 10 holdings, right? The NAV stability correlates highly with tech and AI performance. So that was something I always thought about, right? That was something that I had to make sure, hey, am I okay with holding this, right? These mega caps. It's concentrated. Is it a blessing or was it a curse to me? And then, of course, tax efficiency, section 1256. At the time, I didn't put too much effort and too much thought into this. As now you guys know, for those who are new, I always talk about tax efficiency. Because why would you want to give your hard-earned money back to Uncle Sam, right? Uncle Sam does nothing with it but give it away. Or they just squander it, right? Why would you want that? Personally, for me, if you don't care, right, perhaps I should create a Patreon and you can give me the money. But for me, I like to keep as much as possible. So at the time, I didn't think about it. Now we always got to talk about that tax efficiency, right? The IRS approved yield hack. SPYI utilizes Section 1256 contract on the SPY on the SPX index options. That gives us the 60-40% rule, right? Gains are taxed at 60% long-term and 40% short-term capital gains, even if held for 1 day. This boosts your after-tax yield significantly compared to single stock options taxed at 100% ordinary rates. So we have to think about that. At the time, I didn't. It was just another bonus, another okay. That's good, right? At the time, when I was going into these three, my main concern was, will it recover from a crash? Does it have NAV erosion? Does it actually protect the NAV, right? NAV appreciation. That was one of the main focus. And of course, the later, the yield and the tax and all this other fun stuff. All right, let's talk about QQI. Growth on rocket fuel. This was going to be kind of my quote-unquote the riskier right after Bitcoin, right? So volatility is your friend. At the time, we were still on a crazy bull market. All right, this was like 4 months ago, really. It was not that long ago. This was about 4 months ago. Volatility is your friend. QQI applies the same strategy to the Nasdaq 100 NDX. The Nasdaq is more volatile, right? The beta is 1.1 to 1.3. So it doesn't always go one for one with the market indexes. Higher volatility means higher premiums, hence why the yield is slightly higher, right? QQI's yield is about 14.28 versus SPYI's yield 12.16. Higher, but nothing crazy. Why QQI leaves QYLD in the dust? Of course, I made these scenarios in my head at the time. I compared the Qs with other Qs, and look, NEOS absolutely dominates, right? The QQI's from NEOS strategy was call spreads, has upside participation, it's tax efficiency plus rock, management is active, right? So it absolutely destroys QYLD and JEPQ. Tech concentration risk, right? Of course, I always ask myself this. Am I double dipping? The top holdings, Nvidia at about 9.13%, Apple at 8.5%, Microsoft at 7.4%, 50%, right? Holding both SPYI and QQI means you are doubling down on the same top 5 companies. In a tech wreck, both legs suffer. Option income is a buffer, not a shield against a 30% drop. Alright, so monthly checks. Distribution hover between 0.58 and 0.64 cents per share. This consistency allows you to match cash flow against monthly liabilities like your car or mortgage. So something I asked myself was, especially for SPYI, which is why I really love SPYI. It had historical data, right? So I can look back on what happened during a crash, what was the distribution during those crashes, and when it recovered, what was the distribution during the recovery. And that's why I was so convinced. My conviction in SPYI and QQI was it was unshakable at that time, because it just meant that they were they were holding true. They were not faltering, and that's what kind of almost made me pull the trigger into buying all three and just leaving it like that. All right, let's talk about BTCI, the yield turbocharger, right? This was going to be the one to boost my yield and boost my income a little bit, right? It was going to be my core satellite to kind of complement my two cores, right? So Bitcoin volatility equals cash flow. BTCI makes the 18% yield feasible. Yield ranges from 27 to 36%. Without it, my portfolio would have yielded about 13%, right? It's the high octane fuel for my income ladder. So this was going to boost my yield and income, of course. Why are yields so high? Well, of course, the hyper volatility, right? I understood that. I own Bitcoin myself, right? Bitcoin can move 15% in a week, and that's probably little, right? Option pricing relies on volatility. And then there goes the massive premiums, right? Hyper volatility equals massive premiums. 27% is the market clearing price for the risk. Right, future options magic, right? Synthetic strategy. Unlike spot ETFs, BTCI uses a synthetic cover call strategy. The portfolio is to invest in Bitcoin futures, ETFs, and ETPs. The options, they write and or sell call options on these futures. For fragility and risk, the drawdowns, of course. Bitcoin can drop 70 to 80%. Right, we haven't seen that yet. Right, options crush small drops, not crashes. And then of course, NAV erosion in a crypto winter. NAV erodes, right? $44 share price to $22 means my income is cut in half. Something I did think about and something I did factor in. All right, validating the 18% yield. For those who are new, right, we always want to ask where the money is coming from. How are they making this yield? Is the yield real or fake? So about the 18% yield, right, do the numbers add up, assuming equal weight? Right, at 33.3% each, SPYI, QQI, BTCI. My conclusion, my 18% claim is mathematically valid, right? They all make up the 18% yield and they are able to sustain it. Right, the income ladder, from fun money to financial freedom, right? So my rugs 1 and 2 is my early steps. Rug 1 was the fun money. My capital from 10,000 income, 1,800, right? My risk is low. If it underperforms, $1,200, right? Your lifestyle is unchanged. Excellent proof of concept stage. And then rug 2 was my car payment, right? Capital 30,000, income 5,400. Risk is moderate. $450 a month covers a car, right? The warning here is that checks vary. I need a buffer for low volatility months, right? This was the stage where I was at, these low paying dividends, and it was just not fun. Of course, the number capital here is just for easier understanding purposes. So if you can imagine, my portfolio just a little bit slightly bigger, but for the sake of, easier to understand and see, I just kind of crunched it down. Alright, rugs 3 and 4, the grind, the side hustle and part-time job. The capital 75,000 to 150,000. Income was anywhere from 13 to 27 with $2,250 a month. At this level, tax efficiency becomes tangible. My tax advantage: earning 27K from a job is taxed at ordinary rates plus FICA. Earning 27,000 from the trifecta rock creates significantly higher net spendable cash for you. So here I'm just really comparing, right? What my lifestyle would be, where would I be at, how much I need to earn. Pretty much I'm just trying to give myself the whole picture here, trying to give you the whole picture of what was going through my mind. And then rug 5, the mortgage, right? Capital 300,000, right? My income will be $54,000. My risk level right here would be critical, right? The mortgage is a fixed liability. The bank doesn't care if Bitcoin volatility drop. My stress test in a recession yield might drop to 12%. Then it becomes $36,000 income, right? My shortfall of $18,000 a year. Mitigation: I must maintain a 6 to 12 month cash reserve, right? So my dry powder must be huge. And then rug 6 and 7 is my freedom, right? Salary and freedom. My capital is at least $500,000 to $1 million. My income would be anywhere from 90 to 180,000, depending on, how much I invest. And that is comfortable today. That is where I'm trying to be at right now. Obviously, I don't just have these three, right? That was at that time when I was gonna pull the trigger and buy these three. That was kind of my scenario in my head. I needed at least $500,000 upwards to $1 million for my income to be anywhere from 90 to 180,000, and I was just going to call it quits. I do think about the inflation threat. With, of course, government data, with 3% inflation in 10 years, you need $241,000 to match today's $180,000. My requirement: I had to reinvest 20 to 25% of my income to combat inflation, right? Real spendable income is 135,000, not 180,000. Guys, if you're new, I always talk about the buffer, right? If I think the best scenario, not scenario, but the best method and strategy and philosophy is that one, always treat your distribution as a paycheck. Never assume just because they tell you that it's 100% rock. Always assume it's a paycheck and you're gonna get, just give 10%, put 10% of it away for taxes for Uncle Sam. And if you don't need it, and if it's 100% rock, then great. You can either use it to buy yourself a new gift, reinvest it as you should, and or you have it as dry powder, right? It's a win-win scenario. And two, you always want a buffer because let's just say I'm using a round number here, right? This is how my game plan is, right? For example, I want to aim for at least $5,000 a month. At $5,000 a month, you can somewhat survive in major cities, right? New York City, Chicago, Hawaii, California, give or take. You're probably outside of, the city limits, but you're still within city limits, right? You have an hour commute, give or take. This is in generalized sense, so don't go in the comments saying no, you can't do this. I'm just saying, right? Aim to live in the city, but knowing you would never do that. So if in the case that you reach your $5,000 goal, you can always move elsewhere to, I don't know, you can move to Thailand, Vietnam, where else? I mean, I'm trying to think, anywhere in Southeast Asia if you're a huge fan of it. If not, then South America, right? At that point, you need anywhere from 1,000 to 1,500, and you would live like a king. Let's just push it to $2,000 a month, and then you have $3,000 left over. That is the buffer. All right, so that should be a strategy and philosophy mindset you should have and should always keep. That is what I do. I know I am aiming for $10,000 a month. However, I'm realistic. I want to push it to at least $15,000 a month because now I have that extra $5,000 buffer just in case. One, these are premiums, not dividends. Your premiums can fall by 50%. And when it does, what's gonna happen, right? If you had a mortgage, you're screwed, right? If you can't pay your rent, you're screwed, right? Medical bills, you can't pay. I guess you're not screwed in a way. I mean, you can always say, hey, I'll pay you back, whatever, or take out or pay installments. But for the most part, mortgage, rent, groceries, and all that stuff, right? So something to think about and something that went through my head. And that's why I'm saying it on this video, because this video is all about my crazy thoughts. All right, the case for simplicity, right? The three ticker solution. Set and forget. I always think about this when I'm buying a ETF or stock. Can I buy it to set and forget? At least for the most part, right? I know these are cover call ETFs, they're actively managed. So you should always somewhat actively manage it too, for the most part, right? So set and forget. I want to outsource complexity. Achieving 18% usually requires you to identify 30 stocks, sell calls, monitor delta, and row positions. Not for me. Didn't want that. Too lazy. I want to enjoy the beach, right? I want to sip on some nice champagne, enjoying a nice 75 degrees, 80 degrees, nice cool winds, right? With SPYI, QQQI, and BTCI, I outsourced this pros to Mr. Garrett and Mr. Choi, the founder and co-founder of NEOS. Thank God for these two, right? 3 buy orders, 0 headache was my game plan. Alright, storm-proof cash flow, SPYI, Safecore, QQI, Growth Engine, and BTCI was my alpha generator, right? Covered the entire risk spectrum. If tech rallies, QQI capture it. If crypto surge, BTCI delivers. So I had it all. I covered all fronts. Didn't matter what you did to me, I was covered. Automated cash flow, right? Paychecks a year, 36. Funds pay monthly, 3 funds times 12 months, 36 checks. Most liabilities are monthly, right? This frictionless matching is a huge operational benefit for you. So I was like, you know what? Why not? Why not? And these were the things that were going in my head. Alright, tax characterization, hidden alpha, return of capital, rock, QQI was so far 99%, SPYI was about 96%, and BTCI was about 95%. Rock distribution are not taxed when received. They lower your cost basis. Tax are deferred until you sell. If you never sell, deferral lasts decades, of course, depending on how much you invest in, and reinvest, because that does help. And of course, if you have kids or want to pass on your stocks, it's called a step up basis. So you could essentially never pay taxes if you play it out well. Not tax advice. Please ask your accountant. I have my own personal accountant, so please, hopefully my tax accountant are not wrong, not giving me false information. But please always reach out to an actual tax advisor, okay? Alright, the risk. We always got to talk about the ugly side, right? NAV erosion. Don't let yield kill your principal. If funds distribute more than asset generate, share prices falls, okay? This one is kind of common sense here. You're paying out more than you can earn. Alright, timing is everything. Entering at a peak creates unrealized losses. However, if you are reinvesting like you should be, right? Not financial advice, but if I'm doing it, I think it's a good idea that others should see what's happening here and follow. You could dollar cost average. And then we got to talk about sequence of returns, right? Crash now, cry later. If your $1 million drops to $800,000 in year one, your income drops to $144,000. Selling at the bottom creates a death spiral. I do not want to ever sell for nothing. Nothing. Unless, of course, I'm going to say there's a but, right? But, however, if the thesis change, whether it's the strategies, the fund's thesis change, or my thesis change, then of course, I would sell. Alright, implementation strategy, cross reinvestment. I would turn Bitcoin's cash into stability juice, right? Use BTCI yield to buy more SPYI and QQI. and then I would follow my cash buffer rule. I would try to keep 3 to 6 months of oops money in a high yield savings account or whatever account that it would be more favorable to me, right? If yield drops, draw from buffer, not your portfolio. That was my strategy, trying to keep it simple, easy. All right, my verdict, of course, right, cash flow made sexy. The income ladder is a valid framework. 18% is supported by data. It is the easy button for high yield. My recommendation was great for accumulation. Caution for full freedom, right? The 8% yield should be treated as a target, not a promise. Okay. Why did I not do this? Well, I did have all three, but I expanded. I will be getting back into SPYI and QQI for those who know. Um, right now, I am building up my Maggie position, MAGY. My philosophy really, I guess I wasn't in a rush, and I didn't really have that need. It was at the moment where I had to really just sit back and think, hey, why not go for the lower yield since I have time right now? I have a job. Why go ahead and just pour all of this in? And there was no need for me to rush. So I did step back and look outside of the picture, and I questioned it. I said, I'm gonna go for a little bit lower yield with GPIX, GPIQ. I'm gonna go with growth first and then income, right? QDVO, QDVO. And then I'm gonna build out at least one weekly, which was Maggie. I still have my turbo booster yield, which is BTCI. I just rotated what I had from SPYI to QQI into Maggie. So once I fully built out Maggie, SPYI and QQI will be most likely my next build up along with BTCI. So yes, that is still going to be the game plan. I just diverted a little bit. I kind of delayed it, but I will still be aiming for SPYI and QQI to be a core in my portfolio. So these were my thoughts 4 months ago. I really want to make a video about this. Hopefully you guys stuck through it. I know this was a lot of me yapping and talking. Um, hey, maybe you guys have all these three and had the same exact thoughts as me. Maybe now, if you did, leave a comment. Maybe you be able to convince me to actually go down this path. But yeah, this was I almost went all in BTCI, and I really thought about it too. So I didn't go too crazy. I was like, you know what? Let me buy SPYI, QQI. I did. But then I also expanded to the Goldman, which really became my favorite. Absolutely love those two duels. If anything, I would, if I had $1 million, I would just split 50-50 into those two, really. I mean, honestly, I don't know. Yeah, that was my crazy rant for this video. Thanks for watching, guys. Please leave a like, comment, and share if you found value in my ranting, in my crazy, my mental yapping. Thanks for watching, guys. Stay tuned. Catch you guys on the next.